let's get started very basic here. On the economy there, you're there on the ground. How does it feel like?
It feels good. I'm vaccinated and it's summer and I'm actually on vacation this week. So talking to you from my cottage, I feel pretty good.
Okay.
Looking forward to the July 4th holiday, right?
Well, yeah, I mean, we'll talk about pricing in a bit because this thing, liquidity, is really putting up markets for a big risk in terms of if we do get a disappointment in the jobs number. Now, okay, let's talk about jobs then and the economy. Does this feel like an economy that might be able to withstand rate hikes in, say, about a year and a half?
I think so. I do. And, you know, it's a tough balance because you are balancing the jobs and unemployment, and in particular, the participation rate with what we're seeing in terms of pretty high valuations in most asset markets. But I do think the economy, you know, it's subject to caveats that, you know, as the Fed always says, the data is always changing and the policy is always data dependent. But I think we're on a pretty good trajectory now, and certainly in a year and a half. I think we would be able to sustain slightly higher interest rates because, you know, the economy needs to be able to make it on its own. The Fed can take us a long way, but we really need the fundamentals to be strong. And so, you know, I'm looking forward to a market that isn't reliant on so much central bank support.
Well, the other part to that equation is central bank support as it pertains to markets. That's also one of your areas of expertise here. We'll talk about tapering, of course, even before we get to rate hikes. Do you think the distortion created by all these buys, whether that's directly in the bond markets or liquidity in the equity markets, do you think we'll feel that through the tapering process?
I think that the Fed will probably only taper when their risk appetite from private investors is high enough and demand is large enough for those instruments that the Fed has been buying. So demand for mortgage-backed securities, demand for treasuries, I think in private markets is pretty healthy. So I don't expect a lack of buyers when the Fed is moving away from those markets.
Andrea, when it comes to the question of inflation, we saw those input prices out of the ISM survey out to 42-year highs. We've, of course, got the OPEC story, the fact that they're wrangling over that deal. And you've got, of course, oil above $75 a barrel. Is it looking less transitory to you now?
No, I still see the inflation that we're seeing as transitory. I had a look at inflation break-evens. Inflation is highly dependent on expectations, and my expectation is that that inflation is transitory. The oil price increases, you know, they're not outsized relative to an economy that's really coming back from being fairly asleep for over a year. So I do think that the inflation pressures are transitory. High commodity prices, we have supply chain disruptions, we have people coming out of hibernation. But I don't see expectations coming untethered. I don't see any, you know, there aren't any bond prices or inflation caps and floors that are prices that are troubling to me. So I think so far we have expectations pretty anchored around, not too far above the Fed's target of 2%.
Okay, you've got a 10-year yield at 1.45%. Do you expect that compression around the longer end of the yield curve to continue? It's quite startling for some, 1.4% on the US 10-year.
Yeah, and so I think you'd be hard pressed to be very worried about inflation and at the same time very worried about a 10-year yield of 146 basis points, right? So yeah, I think we have very low 10-year yields, and that's probably one of the reasons that I believe that there is enough private demand for U.S. Treasuries that the Fed, you know, might not be required to be buying as much Treasuries as it has been, you know, very far out into the future.
And the notion, I guess, let's circle back, tie everything together. Final question for you, Andrea. The notion that about 12 months back, people were talking about, oh, this economy sustained either permanent or semi-permanent damage. Do you think it's the right time to basically put that notion to rest?
No, it's too early to put that to rest. I think, we've seen the last at least two recoveries, the '01 recovery and the recovery after the great financial crisis, have been very uneven. And so those are the kinds of things that I think we still, need to worry about. And it's still unclear how this recovery is going to treat people at different parts of the income distribution.